All right, welcome back to chapter 4, the segment on fixed assets. So here, this is what I want to kind of let you know now that we went through what depreciation is and what is expected in terms of why we use depreciation and how we journalize these adjusting entries. Everything here on out, so learning the different methods, right, is going to go a little quicker because you know exactly what to look for. So the next one that we did, so yesterday we did units of production. It's mostly commonly for anything that does produce or have some kind of output. So again, like I said, a copy machine, right? Its output is it prints a bunch of sheets, right? So think about any large machinery equipment that builds stuff, right? Usually, typically that will have some kind of units of production, right? It's based on some kind of measurement. So a vehicle, right? It's based on miles, right? So that's a great example of why we would use units of production. Now, so before I begin, all these depreciation methods that I am showing you, so again, there's like that list of 5 or 6 different ones. There's a lot of different depreciation methods, but at the end of the day, I'm going to show you the 3 most common ones, and you guys get to choose as a company, right, how each fixed asset is going to be deemed as what you want to calculate it as. So if you are looking at some type of machinery equipment that does some kind of output, you're more likely to use units of production. Now remember, you can have multiple fixed assets with multiple different costing or depreciation methods because not one size fits all. However, we will take a look at the difference between the 3 that we learned, and by comparing and contrasting, right, you're going to see that one is done more frequently because, again, you can use one method and apply it to all of your fixed assets if it makes it that much more easier. But I'm showing you the difference between the 3 because of the way that you're using it is why we would consider the following. So the next one we're going to talk about is going to be double declining method, okay? Also known as accelerated method. But again, double declining method. So what makes double declining different than what we did for the previous one, which is units of production? Under double declining method or double declining balance, doesn't matter which one it is, as long as you see double declining, accelerated rate, one of those, right? They're interchangeable, but in this case, it's mostly known as double declining, is where when we use our fixed assets, we have a huge tendency to use more of it in the beginning stages of the asset's life, okay? And then again, we would use it less as it ages over time. So this one's very typical of electronics, right? Or let's say if you bought a laptop for school, right? You use it every single day, but as soon as you finish school, what happens to that laptop? You go to work. You don't really use it as often anymore, right? And then maybe you turn it on, maybe, once a week, and then it becomes once a month. At the end of the day, that's a typical thing, especially when it comes to very common technology, because again, especially when something comes out for the very, very first time, you're more interested in messing around the features, checking out, setting it up. But once you have that done and set in place, you then slowly have a tendency to do other things that don't use that electronic. So that's a very common thing that happens. And this is why you would use double declining, because you would end up using it more and you would probably depreciate it twice as fast, right? Hence the keyword double declining, right? So this is where the formula will make a difference. The first one here is the depreciation basis, right? Instead of using asset cost minus salvage value, you are going to be using the beginning of the year's book value. Okay, BOY, boy book value, just for short. Okay, beginning of the year's book value. Because here, since the idea of us declining twice as much in the beginning stages of its life, right? You're having the tendency that at the end of the day, the book value is going to shrink pretty quick. So therefore, because you're going to be depreciating it twice as much, that is exactly why the basis you're going to be using is going to be the beginning of the year's book value. Okay? And of course, the depreciation rate is going to be 1, as in the number 1, as a whole number, divided by the number of estimated useful life multiplied by 2. Because remember, you are going to depreciate twice as much because you are declining it twice as much. Okay? So we call that double declining. So this is it. So you're going to take 1 and you're going to divide that over the estimated useful life in years, right? And multiply it by 2. That's double declining. And then depreciation expense is going to be basis times rate. Okay, pretty straightforward, basis times rate. And then the accumulated depreciation and the ending book value, these formulas will be constant. Doesn't matter what method you use, these two formulas will not change. So to determine accumulated depreciation, once again, it's going to be your current year's depreciation expense plus the previous year's accumulated depreciation. And again, the ending book value is your asset cost minus the current year's accumulated depreciation. Okay? So remember, the reason why we would use double declining is that you have a tendency to use the fixed asset twice as much in the very beginning, or you would use it more frequently often in the beginning of its life. And as it goes on in age, right, you slowly would use it, right? So this is also going to be very common, especially with electronics, because we all know as the electronic ages, right? We know for a fact that technology does take a huge toll on age when it comes to electronics, right? We know that by the time it's 5, 6, 7, 8 years old, it has a harder time to turn on. It takes longer to turn on and things like that. So this is exactly the reason why you would use double declining, because you are less likely to use it if it takes too long to turn on or it takes too long to load. The operating system is much slower. At the end of the day, you are likely to use it in its prime years, which is the very beginning of its life. And you're going to use it more frequently than you would throughout the year. So you would decrease it twice as much. Okay? So let's take a look at the same exact example of that double fryer that we were looking at here. So again, on January 1st, Nathan's Donut School purchased a donut fryer for a total cost of $2,500, right? And it has, it can fry up to 1,000 times before it needs to be maintenance, okay? And has a useful life of 5 years, okay? At the end of the useful life, it should have a salvage value of $250, and at the end of the first year, December 31st, right, record the adjustment. Okay, so here's what you're supposed to do. So this is all the information you're given. Remember, first step of doing depreciation is recognizing those 5 components, right? So the 5 components is, the first one is determining the asset cost. We already said it was $2,500 for the air fryer. Number 2 is to determine the estimated useful life in years or production, right? In this case, we're focusing on years for double declining. So therefore, we said it will last you at least 5 years, optimal, okay? 5 years. Third one is determining if there's a salvage value. In this case, we do have a salvage value of $250. Fourth thing was the date that you placed into service. Here, we did it on January 1st. And last but not least, number 5 is to determine the depreciation method, which we are doing double declining. So now that we've determined the 5 different components, we now will piece it together in our table to figure out what this is. So here's how the difference between this one and units of production. I'm not given what I was produced that year, because here we don't care about what is being produced. We care about the time. Okay. So here, this is very time sensitive. So we're looking at the rate being over a period of time, which we said was 1 over the estimated useful life in years times 2. Okay, so we don't care about what's being produced. We care about how much we're going to depreciate for the first year of its, operations. So therefore, the first thing we're going to determine is the basis. So the basis is going to be, again, beginning of the year's book value. Now, if I've never depreciated this asset at all, right, what would the book value be? The book value would be the asset cost, because whatever you purchased it at, that is what the value is on your books. Okay, so therefore the very first year, it should be your asset cost, which we know to be $2,500. So therefore that is your beginning of the year book value, and that is your depreciation basis for the first year is $2,500. Okay, so then the next one is going to determine the rate, which is 1, the whole number 1, divided by the estimated number of useful life in years multiplied by 2, because we're doing double declining. I want to do it twice as much. So therefore, let's go ahead and determine, we already said that it's 5 years, so 1 over 5 years should be 0.02 or 20%, however you see it, multiplied by 2, because you're declining it twice as much. So therefore, it goes 20% times 2 equals 40%, or 0.04 or 0.4. Okay, so there we go, 40%. Okay, and again, how do we determine the depreciation expense for the year? It's going to be basis times rate. So what is 2,500 multiplied by 0.04? 0.4. Okay, therefore that's going to give you $1,000. Okay, again, accumulated depreciation, it's current year's depreciation expense plus previous year's accumulated depreciation. In this case, always, since this is the first year we're depreciating, you don't have a previous accumulated. So therefore, it's just going to be current years, which is 1,000. Okay? So then the last thing you're going to determine is the ending of the year book value, which is asset cost minus current year's accumulated depreciation. So here, asset cost was $2,500 minus the 1,000 that you got the accumulated depreciation for that year. You should be left with 1,500. Okay? Right? So, this again, we already practiced how do we journalize that transaction. So this is what it will be. You're going to put, right, depreciation expense for the accumulated depreciation, and especially for the first year, it's going to be for $1,000. Okay? All right. Good so far? Okay. So remember, this is probably the easiest portion of the entirety of the lesson, right? Because under depreciation, as long as you can identify the 5 components, all you need to do is plug in and calculate. That's as easy as it is. There's no rules, there's no nothing, there's nothing more to it. There's nothing that you have to do except for identify the 5 components and plug in and calculate. Okay? So this one should be fairly easy. Now, what about the second year? What happens if it's the second year, right? And we want to know, right, on the second year as of December 31st, right, we need to record the adjustment. So here, how do I know? For the depreciation basis, since this is the beginning of the year's book value, what is the beginning of the year's book value for year 2? 1,500, because again, if you end year 1, December 31st, and your book value is ending, right? Because we saw for ending book value for 1,500. What does it mean when it becomes year 2? It becomes the beginning of year 2. So therefore, taking this number that you saw from the previous year's book value, you're immediately going to identify that that is your depreciation basis for the second year. Okay? So therefore, it's 1,500. Okay? So then, next is rinse and repeat. What is the depreciation rate? Depreciation rate is going to still be 1 over the estimated useful life times 2, which in this case, 1 divided by 5 years, right? Multiplied by 2, because you want to do it twice as much, it's another 40%. Okay? So this is, once again, now we're looking for the depreciation expense for year 2, which is basis times rate. What is 1,500 multiplied by 40%? That should give you a total of $600. Okay? All right? So again, now that you depreciate it again by almost half, right? You did 40%. Therefore, you got $600. So out of that $600, we're going to add it to our accumulated. So far, we have a total of $1,600 that we depreciated out of our fixed asset. So therefore, my ending book value is going to be my asset cost minus accumulated. So therefore, it should give you $900 left. Okay? And of course, if you continue on forth, this is what's going to happen, right? You carry that 900 to the next year, right? Then you solve for, carry that book value to the next year till you are at year 4. Now let's take a look here. Year 4, we have 540 as our book value, right? For beginning of the year 4, we took 40% of that. So therefore it was 216, right? Then we added it to our grand total of accumulated depreciation. So therefore my ending of the year 4 for my book value is 324. Okay? So notice this, right? We're on year 4 and we're at 324. Okay? So can I continue to depreciate for another year? Yes, you can, because your salvage value your book value has not reached salvage value, right? You're not close to it, right? The salvage value is 250. We're at 324. Okay? Well, let's see what happens. What happens? Okay? So this is what you're going to notice, right? You're going to notice that your book values, your ending of the year book values is going to be in translation, right? Your depreciation basis. The only thing that's staying the same is your rate, because your depreciation basis, since it changes and your rate stays the same, then therefore your depreciation expense will stay the same. Okay? But let's see what happens when we do go for a 5th year. Okay? So if we're taking 324, right? What happens when we go beyond capacity? Sorry, guys. What happens if we go beyond capacity? Right now, we can go another year, because right now it's only 4 years and the book value has not reached salvage value. But again, what happens when you do go beyond capacity? Things happen, right? Wear and tear, the machinery or whatever it is that you're using will break down because it's reaching its end of its life. And especially if you use it so much more in the beginning of its year, towards the end of the year, it might not even last you the 5 years. Okay? So again, defective items could be produced. Again, things might not be produced correctly. Again, wear and tear, machinery will break down a lot more easier. Yeah. And again, for this fixed asset, right, it is definitely not recommended to even push your asset above and beyond its capacity, or in this case, especially when it goes over time, right? Because we said that under this method, it is time sensitive, right? Because we're measuring the rate based on the life of the asset, okay, in years, where it doesn't matter how many units you produce, but at the end of the day, once it's exhausted out and it does go to reach its salvage value, you shouldn't go past that, because here, right, once again, things will definitely backfire on you. It will definitely cause many more issues, especially when it's reached its end of its optimal prime years, meaning the years that it will give you the best output. Okay? Now, of course, we know for a fact that when we have our fixed assets, of course, just because the box label says it only lasts you 2 years, that is if on average you use it every day. But again, if you're using it here and there, of course it's going to last you more than 2 years. In fact, it could probably last you 5, 6, 7, or even 10 years, right? If you're using it very, 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 very minimal, right? But at the end of the day, especially when it comes with technology being involved. So again, where this is more geared towards electronics, because typically with electronics, you would use it for double declining, right? Because of technology being involved, it shouldn't even barely last you 7 years, right? Because of the way technology is wired, right? Things do wear and tear, especially when electricity is being involved. Okay, because electricity damages a lot of the equipment that we do use. So, best recommendation here is that once you reach salvage value, right, you should not have your book value ever go or fall below salvage value. Okay, so here you can only depreciate up to the amount, right, that it will give you your maximum output. But at the end of the day, your book value should always be equal to your salvage value. Okay? Because once you've done that, that means that's the minimum, that's the maximum amount you can depreciate up to is the total value to get your book value to equal salvage value. Okay? So let's take a look at that year 5. So if I were to go ahead and continue on with year 5, we do $324, right? 40% of that's going to give me $129.60. And again, that's going to be added to my accumulated depreciation for $2,305.60, giving me my book value to fall below salvage value of $194.40. Okay? So in this case, my 5th year ended having me fall below salvage value, which is a big no-no, because we said it is not recommended to ever go below salvage value. Okay? So here, even though we are on its 5th year, we said because we're using it twice as much as the beginning of its life, it may not last you the 5 full years. Lifespans will get shortened, especially if you use it more often in its beginning of the year, right? If you're using it twice as much, then you can definitely expect that it will not last you much long, because again, you're depreciating it twice as much. So therefore, it may or may not ever reach its entirety of its estimated useful life. So because we have a salvage value put into place, right? 250 is the maximum that we can have it to be. So what we need to do is we need to adjust and recalculate our information, because this number cannot be accepted. It fell below salvage value. So therefore, how do I go back, recalculate, and make those changes? Well, if we know for a fact that your book value has to be ending in 250 at the end of its 5th year, right? We can always use working backwards to determine how we can be able to solve. So here, right, we know for a fact that book value needs to equal 250. The formula to solve for ending the year book value is asset cost minus current year's accumulated depreciation. Well, we were given your book value and you already know what your asset cost is because it's one of the components that you had to look for. So therefore, plug it in. What minus what is going to give you 250? If you know for a fact that your ending the year book value needs to be 250 and you started your asset cost at 2,500, then you could solve there, right? Plug in and solve. So therefore, 2,500 minus X is equal to 250, which we know is 2,250, right? Simple, easy math. So therefore, we need to solve for what is the amount of depreciation expense you're going to need to do. Again, use your math. If we already know to determine your accumulated depreciation, we know by this formula is that it's going to be current year's depreciation expense plus previous year's depreciation, accumulated depreciation. So therefore, again, plug in what you know and solve for the missing component. So if we know that the accumulated depreciation for the current year, year 5, is 2,250, and we know that we're solving for the current year's depreciation expense, and we have the previous year's, which was 2,176, all you gotta do is plug and solve, and you are going to be depreciating it by $74. Okay? Now, even better, in this case, you didn't have to work backwards. You can work a little smarter, right? You can take the difference between 324 and 250 and immediately you will know exactly how much you need to depreciate. That is the easiest and quickest way to do it. But I needed to show you how to work backwards because again, this is all it is knowing what you're plugging in and literally solving. Okay? So that's another way that you could be able to solve is if you've already identified that your ending balance needs to be 250 and your ending balance previous is 324, find the difference, 74, and that will be your depreciation expense for that year to get your end result to be 250. Okay, so any questions here? Okay, good. Okay. So now let's talk about partial years because this is where it is very important to know the exact date that you place your asset into service. Okay? We've talked about this as being one of the components, right? This one is going to be super, super important because since our rate is based on time, partial years is going to be a huge thing that even though when you buy your assets and you place into service, it doesn't always necessarily have to be January 1st. That's not always the occasion, right? Because we know for a fact that when you start a business, you can start your business any given point in time. You don't have to wait until the very beginning of your fiscal year, right? When you file for taxes, right? You don't have to wait till January 1st to open your doors. You can open your doors at any given point in time. So that means you can put your fixed assets in service at any given point in time. And if you do use it during the year, this is where it's important that when you buy your fixed assets, you treat them with age. Okay? You don't call something if they're born in September and it's December 31st, you don't ever call your child 1 year old. You call them 3 months old, right? You call them 4 months old, okay? You never ever say they're 1 year old. That's the same thing here to fix assets. The day that you buy it, right, isn't what you're looking for, but usually commonly it is, because your first thing you gotta do is you gotta make sure that it does work. But it is when you place it into service, when you actually start using it, is when you start depreciating it. And that's where that whole 1 through 15 and 16 through the end of the month, those are going to be extremely important, because if you use it for more than 50% of that current month, you need to depreciate for that month. Okay? But if you depreciate, or if you put it into service after 50% of the month, there's no point to count how many days you're going to depreciate it, right? You're better off to just start in the very next following month. Now, the months are going to play key roles, because here we also need to do a little extra calculation. Since the estimated useful life is measured in a full year, if I've only used it for, let's say I used it for 3 months out of the year, I need to know that means I cannot depreciate my asset for 1 full year. I have to divide it by the number of months I've used it. Okay? Therefore, remember, especially when it comes to partial years, again, I cannot say my asset is 1 year old when I put into service in September 30th, right? It barely was there for 3 whole months. So why would you depreciate it for a whole year? You would lose, and again, it would be a huge cost to your business, right? So here we're going to measure the length of the 3 months and divide the depreciation expense for the whole year, right? To get you exactly the 3 months that you actually used it for. So here, that is exactly what partial years is that you are going to depreciate for only partial of the year. Because on the first year, if you place into service in the middle of the year, you shouldn't be depreciating for the whole year. Okay? So again, let's take a look at this example here. So again, we are going to be needing to utilize that strategy where we said if you place it within the first 15 days, that is more than 50% of the month. And again, if you put it in place the last 15 days of the month, you're better off depreciating in the next month. Okay, so let's go ahead and take a look at this example. So if this time it's June 21st, right? And Nathan's Donut School placed in service the donut fryer for a total cost of $2,500. And again, it can fry up to 1,000 times before it needs to be maintenance, and has a useful life of 5 years. At the end of the first year, at the end of the useful life, it should have a salvage value of 2,500. Right? At the end of the first year, December 31st, right, record the adjustment. Okay? So we are assuming that the fiscal year is January 1st all the way to December 31st. Okay? So therefore, because we reached the end of the year, what happens at the end of the year? We got to file for taxes. So this is exactly why this example here is, because of that very first year of wrapping up your books. We just placed the asset into service on June 21st. So what does June 21st tell you? Okay? What does June 21st tell you? When do we start depreciating? It would be the following month, because it's after the first 15 days. So you used it for less than 50% of the month. So in this case, I'm not going to have you record 9 days worth of depreciation, right? Why? Again, accounting isn't super detailed where I'm counting every sheet of paper that the printer produced, right? I'm guesstimating. So in this case, same thing here. I'm not going to worry about 9 days worth of the asset that I use. I'd rather just go ahead and move it forward to the following month. So in this case, July 1st. Okay? So therefore, let's go ahead and follow through with the equation. Okay, so here depreciation basis, once again, is beginning of the year book value, which we said was $2,500. That's your asset cost in first year. The rate is going to be 1 over the estimated useful life of 5 multiplied by 2 because it's twice as much, right? So that's 40%. Now here we know it's going to be basis times rate, which is 2,500 times 40%, okay? Which we know to be, right, a total of $1,000. However, here the rate was based off of 1 whole year, right? We said it was based off of 1 whole year. Now, if I place my asset into service June 21st, right? Have I actually used it for 1 whole year? No, not if it's December, because that's the key component here is I'm depreciating at the end of my fiscal year, which is December 31st. So therefore, how old is my asset? So July, August, September, October, November, December. It should be 6 months, right? Because we're also including the month of December, right? Okay? So therefore, that means I cannot depreciate it for 1,000 because that's for 1 whole year. So therefore, I need to recalculate that because I realistically did not have my asset work for me for a whole year. I've only had it work for me for only 6 months. So again, now we need to figure that out. What is 6 divided by 12, which is how, again, 6, since it is a whole year, you need to determine how much out of the year did you actually use it for. So in this case, since we said that we used it for June, we put it into service on June 21st, we're going to assume that it's going to be there for, we're going to put it as July 1st, July, August, September, October, November, December. That is 6 whole months. So therefore, 6 months out of 12, right? Because we said 1 whole year is 12 months. So 6 out of 12 is also known as 1/2 or 0.05. Therefore, you only use it for half a year. Okay? Now it's very important because you are going to get random numbers. This is a nice, easy example where we use it for half the year. Okay? I can give you random months. I could say April. I could say August. You need to be able to determine out of the year, right, how many months did you actually use it for. So in this case, we used it 6 months out of the 12 months for the year. Okay? Which is also known as 1/2. Okay? So therefore, we gotta multiply the depreciation expense because I did not use it for a whole year. I only used it for half a year. So therefore, it's going to be half of 1,000, which gives you $500. So there, for the first year of the asset's existence, you only used it for half the amount. Okay? All right? Because you place it into service for half the year. Okay? And then you solve for the rest. Okay? So therefore, partial years is important. So that's why those dates are necessary because it's one of the components of the depreciation and you need to know how to use it effectively. So the previous one that we did, units of production, we didn't care. Okay? But this depreciation method, we do. Okay? So any questions here on partial years? So remember, when did we depreciate for the first year? That's when you put the asset into service. I'm asking, when did you depreciate? No. When did I do my adjustment entries? December 31st. Now remember, the table that you see here, this is your accounting year, not what the asset's life is. Okay? Well, no, because guess what? When is the next year you're going to depreciate? December of the next year. And if you place your asset into service and you did it for the first year, right? What does it represent when it becomes January 1st? You're going to depreciate for a whole counting year, correct? So therefore, you would depreciate for a whole year of its life because you're starting from January 1st all the way to December 31st. So in this case, the second year, so these years that you see, so the depreciation table, the years is your accounting year, okay? Not the asset's life, okay? So that's why in the previous one, if you looked at the previous one, right? We were lucky that the asset's life as well as the accounting year was the same, but I was very specific. You depreciate at the end of the year, December 31st. Okay, so therefore, if you place the asset in service on January 1st, you have depreciated a full 12 months. But at the end of the day, right, just because you're on the 5th year of the accounting period, it may not last you that 5th year. Okay, so again, the depreciation table works slightly different. That you're looking here at your accounting year, not the actual asset's life. Okay, all right. So that is that. Any questions here? Okay. So again, that was double declining. All right, so we're going to go ahead and do the chapter exercises. So let's go ahead and take a look at the first question here. Okay, so again, we're going to calculate the annual depreciation for a backhoe using the double declining balance method and record the adjustment entry. Okay, excuse me. So again, let's go ahead and use the table below to calculate and determine each year's book value. So again, here's your information. You place it in service on January 5th. The company purchases a backhoe. And again, the equipment cost you $45,000 and has an estimated useful life of 5 years. Okay? And can produce up to 10,000 units, right? Or it could scoop 10,000 times, okay? And of course, it has a salvage value of $10,000, okay? So first things first is let's determine the 5 components. So the first one is, what is my asset cost? The asset cost is, no worries, so $45,000. Good. Okay, what is my salvage value? What did we say will be the end of its life? What's the salvage value? What is it going to be? 10,000. Good. Okay, $10,000. Okay, what is the date that you place it into service? What is the date that you place into service? January 5th, okay? Sometimes the purchase date can be the same as your day that you start using it. Because remember, what is the number one rule, even for inventory management? What's the number one thing that you do when you buy a fixed asset? Yes, that is also true because here it's more than 50% of the month, right? You put it right in the very beginning of the month. But also, again, are you going to buy, for example, are you going to buy a printer and wait 6 months to actually plug it into the wall and start using it? No, but your number one thing that you should be doing is if I just invested, like, let's say I invested $250 on that printer, I better make sure it works. Because what are the chances that you got and purchased a faulty one? So in this case, your purchase date can also more or less, if there's nothing extra that you need to do anything to it, then it will most likely be your service date. Because you got to test it to see if it works. All right, so here, what is the estimated number of units produced? In this case, we don't really care about that one. What about the estimated useful life in years? It's 5 years. Okay, so let's go ahead and calculate our depreciation. So the first one is determining the depreciation basis. What is my depreciation basis? It's going to be $45,000. Why? Because the depreciation base is going to be the beginning of the year's book value. Since we've never depreciated before and this is the first year, your book value is going to be the same thing as your asset cost for the first year. Okay? Good. 45,000. What is my rate going to be? Okay, but you forgot that 1 because you got to divide it, right? You got to go 1 divided by the estimated useful life in years. So 40%, so 1 divided by 5 times 2, right? Because it's twice as much, we're double declining. It's going to give you 40% or 0.4. So therefore, let's go ahead and determine what my depreciation expense is for the first year. Now I'm going to use equal round just to ensure that I get the most accurate number here. Okay, and not run into any rounding errors. So here, what is my depreciation expense for the first year? 18,000. Okay, so let's see. We take basis times rate. Okay, I'm gonna put comma 2, right? And that gives you $18,000. Okay, so therefore, what is my accumulated depreciation for the first year? 18,000. So therefore, what is my book value going to be at the end of year 1? Okay, so we're going to take 45,000 minus the accumulated depreciation for that current year for 18,000. You do get 27,000. Okay. So then what is my depreciation basis going to be for my second year? $27,000 because we said that the depreciation basis for double declining is going to be the beginning of the year's book value. So if you end your first year with 27,000, that means you're going to begin the year with 27,000. Good. Okay? So then what is my rate going to be? It's going to be the same. So for all if you ever reach the 5th year, it's all going to be the same. Okay? What was that? What was that? Okay, so then what is going to be depreciation expense for the second year? $10,800. So again, right, basis times rate should give you $10,800. Okay, so then what is going to be my accumulated depreciation for year 2? Okay, let me see. 18,000 plus 10. What did you get? 38? Plus your current year. Okay. Okay, so 10,800 plus 18,000. 28,800. So therefore, what is your book value going to be? Yes. So in this case, yes. So you should be left with 16,200. Good. So then, third year, 16,200 times 40% will give you correct 6,480, which will give you a total accumulated depreciation of $35,280, which will give you your ending of the year book value to be $9,720. So again, what was my original salvage value? So can I go that third year? Because right now, what is my book value at the end of year 3? It's below 10,000. So here, this back code, because the way that you're using it, it didn't even last the 5 years. Okay? So therefore, how should I adjust this number here? Because it cannot be 9,720. Subtract the 16,200 by the 10,000. Yes. So in this case, right, that's the quicker way to do it. Go ahead. That is one way you can do it. Yes. So let's do it that way first, because if you know that at the end of, so this is supposed to be third year, so I'm gonna erase this because it didn't last. Right. Let's say it's third year, if you're supposed to be at $10,000 for your book value, okay, how do you solve for your accumulated depreciation? So we know for the fact that your book value, right, if I do my formula, book value, so I'm going to do BV for short, book value is going to be equal to, what is it? Okay, formula first. How do I solve for book value? Good. So asset cost minus accum depreciation, right? That's the formula. Now, if I'm given my book value to be $10,000, right, equals what I'm solving for, what's my asset cost? 45,000 minus my accumulated, right? So this one, pretty straightforward. Go ahead and plug and solve. Okay, so my asset cost minus what is going to give me 10,000? Correct, right? I can also do my math there. 45,000 minus 10,000 should give me 35,000. Okay? Now, to solve for my accumulated depreciation, hold on. Okay, so my accumulated depreciation is going to be current depreciation expense, right? Plus previous accum, right? Okay? We know that this formula is true, right? So therefore, if my accumulated depreciation was $35,000, right? Equaling, we don't know what the depreciation expense is, so depreciation expense plus what is my previous years? What was my previous year? Accumulated. What was my previous year's accumulated? Okay, 28,800, right? So let's solve. Okay, how do you get to 35,000 if you are at 28,800? No. So again, your accumulated depreciation is the current year's depreciation expense plus the previous year's accumulated depreciation. So here, if I just solved that my accumulated depreciation was 35,000 and I know my previous year's was 28,800, what is my depreciation expense? 6,200. And that's what your third year is going to be. Now again, here, the quickest way to be able to solve this is, what's the difference between the two book values? So again, I'm going to put book value for year 2 minus book value of year 3. So what is the difference between the two? So we said 16,200 minus 10,000. Right? You get 6,200, then that's your depreciation expense, and then you work the rest out and it will pan out evenly. So again, There are multiple ways that you could solve for one answer because this is literally look at the formula, plug in what you know, and solve. So here, instead of having to work this hard to go backwards, right? Let's move forward. If you know for a fact that your book value needs to end at 10,000 and your previous year's book value is 16,200, you already know what it is, right? Subtract the 2 and that will be your depreciation expense. Okay? And then everything should fall into place, right? Because what is 6,200 plus 28,800? That should give 35,000. And then book value is 45,000 minus 35,000, which should give you 10,000. Okay? So again, many ways that you can solve for your answer. Okay? So let me go ahead and include depreciation expense is equal to book value of year 2 minus book value of year 3, right? And that will result in your so depreciation expense is equal to what was it? 16,200 minus 10,000. Okay? All right, so now let's go ahead and do our adjustment entries, assuming that you're doing your adjustment entries at the end of the year, December 31st. Okay, so how should my adjustment entries should look like? For the first year is 18,000. Accumulated depreciation. Good. Okay. And how should my journal look for the second year? It's the same journal, but the difference here is what are you going to journalize for the second year? Good. Okay. Excellent. Okay. So the journals will stay the same. Doesn't matter whether it's the year or whether it's the depreciation method. The only difference here is what number you're going to be debiting and crediting. That's the difference. Okay. Good. Excellent. So that was example number 1. Okay. Good so far? So let's go ahead and do the next example here. So example number 2. Once again, you're going to calculate the annual depreciation for a conventional oven, okay, using the double declining balance method, okay, and also record the adjustment entry. Use the table below to calculate and determine each year's book value. So this time, right, it is June 25th. And the company decides to purchase a double-door commercial conventional oven, okay? And the equipment cost you $100,000, okay? And has a useful life of 10 years, okay? And of course, it can bake up to 50,000 times before it needs to be maintenance. And of course, it has a salvage value of $10,000. So again, let's go ahead and determine the 5 components. What is my asset cost? 100,000 for the oven. Okay. What is my salvage value? It's 10,000. Okay. What is the date that I placed it into service? July. Okay, so in this case, June. So June 25th will tell you July 1st. Good. We don't care about the number of units it can produce, but what is the estimated useful life on my asset? 10 years. Okay, good. So let's go ahead and plug and solve. So what's the first one is, what is the depreciation basis for year 1? $100,000, right? Because we said it's beginning of the year book value. Since we never depreciated before, your first year will always be your asset cost. Okay? What is my depreciation rate going to be? 20%. It's going to be 1 over the estimated useful life of 10 years multiplied by 2 because you're double declining it. So that should be 20%. So therefore, what is the depreciation expense for the first year if you're going to do 20% of 100,000? Basis times rate. Basis times rate will give you 20,000. Okay? All right. What is the accumulated depreciation? Okay, 20,000. Okay, giving you your book value for the first year to be okay. Now let's take a look at this. If assuming, right, I'm depreciating at the end of the year, December 31st. Can I depreciate for the first year a total of $20,000 for my conventional oven? No, you can't, right? So remember, this is the accounting year, okay? Not the assets year, okay? So when did I place my asset into service? Okay, so in this case, we purchased it in June 25th. So therefore, right, that's 5 extra days. We're going to treat it as if July 1st. So again, if I'm using it all the way to December 31st, right, how many months is that? We said 6 months, right? So therefore, how much of this 20,000 am I actually going to depreciate my asset for the first year? Half of it, okay? So again, 20,000, right, multiplied by 6 over 12, right, also known as 0.5, should give you 10,000, right? And because I cell reference, it fixed all the rest of my information as follows. So therefore, accumulated is 10,000, book value is 90,000, okay? So again, you have to be very careful when you're looking at this. In this case, assuming, right, you're at the end of the first year, which is December 31st. Okay? So therefore, we just had a partial years. So let's go ahead and continue on for the next year. So again, what is my depreciation basis for year 2? Yes. Well, go ahead. Okay, let's ask that question. So here we determined that July right? All the way to December. How many months is that? Correct. And what is 6 months out of 12 months? That's half the year. Okay? So if we put it, okay, so how many months it goes from April all the way to December? Okay, and that's 8 out of how many months? Correct. So what is 8 out of 12 months? Right, it's or also known as, what is it, 3/4? Or two quarters? Or no, the 3/4? Well, in this case, right, the math here, if you want it to be very specific, I would just do like, so if you look at my formula, I actually did 6 out of 12. Okay, because again, not everything's going to be panned out even. It's not going to be half a month, not going to be a quarter of a month. But in this case, what is 8 out of 12? That should be 2/3, right? Is it 2/3? Okay, because you used it for 8 out of the 12 months. That's how you always have to calculate it. So if this was April and I need to know how much 8 out of 12 is, right? Instead of doing 6 out of 12, I change that to 8 out of 12 months. Okay, same thing with October. If it was October to October, November, December, that's 3 out of 12 months, right? So again, you treat your assets like you treat your kids, right? So in this case, would you call your kid a whole year old when they were born in April? No, you would say they were 8 months, right? Same thing with October. They're only 3 months old. Well, no, we should be on it because we're on the topic right now before we continue. Okay? Now, here, when I calculated, right, when I just calculated my depreciation expense, right, we said my depreciation expense was for the year, okay, for the first year, okay, was depreciation basis times rate. Now, because this is an accounting year, can I depreciate for the full $10,000 or for the full $20,000? Excuse me. Correct, because I did not depreciate it for a whole year. So that's what this number year represents, is the accounting year. So no, I did not use it for January, February, March, April, May, or June. But I did use it for July, August, September, October, November, December, right? Now, out of that year, how many months did you use? 6 out of what is one whole year consist of? How many months are in one year? 12 months. So therefore, I used 6 out of 12, which is half a year, correct? So therefore, I multiply my depreciation expense because this is for a whole year. I'm not going to use it for a whole year. So that's why in my calculation here, my calculation here is I do this and I put 6 out of 12. Okay? I multiply by 6 out of 12. Correct. Correct. Because I'm only measuring and depreciating for what I used it for. Okay? So because I used it for 6 out of 12 months, therefore it's half, which is 10,000. Okay? Good. No problem. So let's continue on for the second year. So what is my second year's depreciation basis going to be? $90,000, because that's what your ending the year book value was, okay, for the first year. So again, what is my depreciation rate going to be? It's going to be the same, and this rate's going to stay the same all the way through, okay, if you end up even getting to your 10th month, okay, 20%. So therefore, this time, since it's already in service, it's going to go for a full year from January to the 31st. What is my depreciation expense for the second year? Okay, so again, it's going to be depreciation basis of 90,000 multiplied by the rate of 20%. Okay, so in this case, that gives you 18,000. Okay, so if that gives me 18,000, then what is my accumulated depreciation for the second year? $28,000, right? Because you add those two values together. And then what is my book value going to be at the end of year 2? $72,000. Good. So let's do one more year, and then I'm going to forward through because it's just rinse and repeat. So what is my book value for year 3? Or sorry, what is my depreciation basis for year 3? Okay. Again, what is 20% of 72,000 for the third year? 14,400. So therefore, my accumulated depreciation is going to be 42,400, giving you your ending book value for year 3 to be 57,600. Good. So I'm going to fast forward and let's try to make it down to year 9. Okay. I don't know why that didn't work. Okay, because I don't have any values here. Okay, and then of course, pull this down to the 9th year. And again, pull this down to the 9th year. And therefore, pull this down to the 9th year. And all my formulas should pan out. Okay, that 57, right, to 46,080 to 36,864 to 90 to $29,491.20 to 23,592.90 to 18,874.37, giving you your ending book value at the end of year 9 to be $15,099.50. Okay, so again, if I would recommend you to do that equal round, because again, 20% of this odd number is going to give you even more odd numbers. So that's what I did. If you didn't do that in the very beginning, go back and do it because you will have rounding issues. Okay, so therefore, I end with year 9 with $15,099.50. So can I continue and keep going for another year? Yes, because first off, it's only been 9 years, okay? And my asset can last up to 10. But most importantly, my salvage value has not fallen below 0, fallen below 10,000. So therefore, let's do it for one more year. So 15,099.50 times 20% gives me good 3,019.90, which will give you your total accumulated depreciation of $87,920.40, which will give you your book value to be $12,079.60. Okay? Now, have I reached my salvage value yet? Can I continue to go on for an 11th year? Okay, so let's take a look at this. Trivia. How old is your asset right now? Is it really 10 years old? Correct. So at the end of December 31st of the 10th year, how old is your asset right now? It's only 9.5. Okay. So can it go for another half year? Yes, it can. It's only 9.5. So remember, now, because here's the thing, especially when it comes to double declining, can it last its estimated useful life? Maybe. We don't know because it's depending on the frequency that you use it, right? We know that we depreciate it twice as fast in the very beginning of its life, right? But here with our calculation, it seems as if it can continue to go on for another half year, okay? Especially because my salvage value has not fallen below, or my book value has not fallen below salvage value. Okay? So therefore, yes, you can. However, what did we say here? Because if we did continue, you would probably fall below salvage value, right? So let's go ahead and continue on. If you were to go ahead and do that, right? So again, 20%, which will give you 20% of that will give you $2,415.92, which will give you that results, which will give you your book value to be $9,663, which for sure, like I mentioned, you can't, that is definitely below salvage value. Okay, so what should you do instead? Okay. We can try that, but let's see what the result's going to be. Okay, so right now you said 6 months of $2,415.92. So here let's add that. Say we said 6 divided by 12, so half of that is 1,207.96, which will give you 89,128.36, which will give you $10,871.64. Yes, absolutely. You could definitely do that. However, right, in this case, right, especially if we're working on the 11th year. Who's going to actually keep track of that? You bought it exactly on June 25th, and that you're going to stop it exactly on its 10th year. Nobody's going to cheap after you because you're going to definitely have more than one fixed asset. I can definitely tell you that. Okay. You're going to have machinery left and right. So in here, this case, if you did do your duties to keep track of it for that long, right? For 10 whole years, you kept track of it. Great. You're an excellent accountant. However, let's be realistic. Okay. Realistically, if you're going to be dealing with more than just one fixed asset and you're having to deal with this for every single fixed asset, then the suggestion for there to keep track to make sure that you do exactly depreciate it and take it off the books exactly on July 1st of 10 years later, right? That would be near impossible. Okay? But what you can do here is if you did do it that way, great. Then you're able to walk away with having $10,871.64. But here we can also try to depreciate it as much as possible. Excuse me, by taking $12,079.60 and subtracting out your correct. So yeah, so then you'll get the maximum to depreciate it for $2,079.60 for the 11th year. Okay, to give you your end result of your book value to be a nice even 10,000. Okay. All right, so let's go ahead and journalize the first 2 years for the depreciation, okay, because it's rinse and repeat from there. So again, assuming you depreciate it at the end of the year, December 31st. So how should your journal look like? Good. The first year, which was, we depreciated for 10,000. Good. 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 Correct, right? It would be the same journal entry, only difference is the amount is different for this second year. Okay, so the second year, how much did we depreciate my asset for? $18,000. Okay, good. Any questions here? Okay, all right. So last example for the day, or for this first part of the class, right? We still got to do the other method here. So again, we're going to calculate the annual depreciation for a coffee pot using the double declining method. And of course, record the adjustment journal entry. Use the table below to calculate and determine each year's book value. So once again, it is January 1st, and the company purchased a coffee pot, right? The equipment costs $250 and has a useful life of 5 years and can brew up to 1,000 times. Okay. And let's see, it also has a salvage value of $0. Okay, so it has a salvage value of $0. So let's go ahead and determine the 5 components. What's my asset cost? $250. What's my salvage value? 0. Okay, and what's the date that we place it into service? January 1st. So again, if we end the year December 31st, you'll depreciate for a whole year. And what is the estimated useful life in years? Okay, life. 5 years. Okay, we don't really care about how much it can produce. Okay, so number 1, for year 1, what is the depreciation basis? It's okay. We're on the depreciation basis for the first year. Correct, right? It's always going to be your asset cost for the first year. What is the depreciation rate going to be? 0.4, right? 1 divided by 5 times 2 gives you 0.4. So here, on the first year, how much would you depreciate it for? You said 100? Okay. So what's your accumulated depreciation for the first year? Yes, because here there is no previous years because you're depreciating for the first time. So it would be your current year's depreciation expense. And therefore, what is your book value going to be at the end of year 1? 150, right? So you take your 250 minus the 100 and you get 150. So therefore, year 2 depreciation basis is going to be it's going to be the same for all 5 years, so 0.4. So what is my depreciation expense going to be for the second year? 60, which will give you your accumulated of 160, and your ending balance in your book is going to be it's going to be 90. Good. So I'm going to go ahead and pull forward because again, it's rinse and repeat. You got 90. What's 40% of 90? That will give you $36, which will give you $196, which will give you $54. Okay. Year 4 will be $54. 40% of that will be $21.60, which will give you $217.60, which will give you your book value to be $32.40. So year 5 comes around, right? You do $32.40. 40% of that will give you $12.96, which will give you $230.56, which will give you your book value to be $19.44. Okay? So, question is, can you keep your coffee pot going for another year? Well, what's the estimated useful life? How many years can it go? Okay. Well, it can go 5 years, but can you go for a 5th year, or can you go for a sixth year? So if I were to go for another year, okay? Let's say I go for another year. Okay, so when we end year 5, let me make sure my math is right. So 54, we said 34 to 1944. So 1944, 40% of that is $7.78, which gives you a total of $238.34, and giving you an end result at $11.66. Can I go for another year? Now, let's take into consideration, this is a coffee pot. Should you go for another 7 year? Absolutely, that is correct, because especially when you are a smaller type of business, you gotta do what you gotta do, and you will salvage every penny. Now, especially when you have a salvage value of 0, this can go on and on and on and on. Do the math. Go ahead, pull it for another 10 years, and you will see that it will keep going, because your salvage value will never reach 0 until for a very long time. But when we're looking at a realistic standpoint, should my coffee pot go beyond 5 years? No. Especially if it's a $250 one, it could probably last you maybe 7 years at most, but in this case, it's probably, but if it's like a cheap one, like say it's a $50 one, yeah, you're probably good to go after 3 years. But in this case, again, judging by the price of things, that doesn't always necessarily mean that it will last longer. Because again, depending on how much you use it, what if I'm brewing coffee 5 times a day, 6 times a day, 10 times a day? Is it going to even last me 5 years? Probably not. So here the situation is of when you have a salvage value that's 0, you can depreciate this as much and as long as you want, because it will never fall below 0 until very, very, very long from now. Okay? Now, of course, when we have that idea, but we have to also consider what is the item you are depreciating, because realistically, especially things like something that you plug in a wall, give or take, electronics have a minimum of 5 years. Okay? But at the end of the day, as a small business owner, if you want to keep this in your books as long as possible and depreciate it again every year, just think of it this way. What good is it to have an asset that's worth $11.66 in your books? Well, what is $11.66 to anybody? it's not very much. And if you continue to depreciate it for the next year, so another 40%, then it becomes $5.60, right? Then again, another one, then you do $3.25. At that point, what about the value? It's not even going to be worth anything. So what is the point of keeping it in your books? It's chump change at that point. And this is where, if you ever read your book, it will tell you that in order for you to recognize a fixed asset as a fixed asset, it's got to be worth more than $2,000. No, that's different when it comes to being a type of business, because again, just because a product may seem to be cheap or inexpensive, that doesn't mean it doesn't hold value in your business, especially if you're a small business. If a $250 printer, that's expensive to me for my business, and it's going to last me for 10 years. So yes, I will value that $250 instead of just expensing it as a mere expense to the company, where we buy it, it's done, expense. I don't need to count it as an asset. And that is where you have the executive decision. Remember, that's one of the rules. Is it material enough to count it? Right? And that's where you're going to have to wager. Is it worth to depreciate a $250 item and have to adjust your books every year for $250? Or would you rather expense it as a mere expense to the company, and once you have it, that's it. It's permanently in your company forever because you bought it for the usage of your company. So that's where you also get that executive decision. Is it worth the time and effort to hold on to an asset for $250 and have to depreciate it every year? Is it worth it? And that's where materiality comes into play. Okay? So should I even be worried about $11.66? Probably not. You know what? I'm probably better off just trashing it and buying a new one for the office to use, because then I get a new value, a new cost, a new life, and it will produce great coffee. Okay? So at the end of the day, then that's where the next chapter will talk about disposal of fixed assets tomorrow. What do you do once you reach the end of the estimated useful life and you're at your salvage value? What do you do with it? Do you get rid of it off your books? Do you resell it to somebody else that's willing to buy it? Do you fix it to extend the life of it so you can carry on and continually using it? And that's where the next chapter or the next section is called disposal of fixed assets. What do you do once you have depreciated up to its maximum estimated useful life? Okay? And again, any questions for this example? Let's go ahead and journalize the thing real quick before you ask questions, okay? So again, December 31st, how would your journal look like for the first 2 years? Okay, I'm just going to copy and paste because it's going to be the same. But the only difference is, once again, for the first year, how much should we depreciate my coffee pot for? $100. And then how much should I depreciate for the second year? Okay, that's the accumulated 60, right? We did 60. Okay? Any questions at all in regards to double declining?